Hello everyone, welcome back. Thank you for joining me for another quick video. The Bank of Canada warns that there are risks of a sharp correction in markets that could cause system-wide stress. In other words, a banking crisis is coming, and it's not just Canada that will be affected. Yes, it is true that we've been hearing about a possibility of a banking crisis for a while now, but let me share why I think that this particular warning is something to pay very, very close attention to. Typically, central banks don't make similar statements lightly. As you know, it is far more common to hear that everything is going well until it isn't anymore, and then everyone is caught off guard and surprised and shocked. It is far more typical, as we know very well, to hear that inflation is transitory and that economy is booming than hearing about a no longer remote possibility of a systemic risk in the banking industry. The Bank of Canada is effectively cautioning that a sharp correction is very likely, and it will cause a substantial amount of stress throughout the entire system. So here's the video, take a look, and make your own conclusions.
Over the past year, the risk of recession has diminished in Canada and globally. Inflation in most countries has come down, and inflation targets are in sight. However, there could be volatility in markets as expectations shift about when and by how much central banks will lower their policy rates. And there continue to be important geopolitical and economic risks on the horizon. Against this backdrop, households and businesses continue to adjust to past interest rate increases. Some indicators of financial stress have risen. At the same time, the valuations of some financial assets appear to have become stretched. This could increase the risk of a sharp correction that could generate system-wide stress. The recent rise in the use of leverage in non-bank financial institutions could amplify the effects of such a correction. What's most important is that to properly manage risks, financial system participants need to remain proactive, and financial authorities need to remain vigilant.
Here's another reason why I believe that we need to be paying very, very close attention to what the Bank of Canada just told us. The US markets impact the rest of the world. The most recent semi-annual report on bank supervision and regulation was just released by the Federal Reserve in the beginning of May. The data shows that the delinquency rates for commercial real estate loans, as well as some consumer sectors, increased to multi-year highs. If delinquencies rise, there's really not much that banks can do. It is a very alarming trend. This is why Fed Chair Jerome Powell said that he does expect bank failures, and those will be primarily smaller banks. He said this about a month ago or a month and a half ago. So what's the reason for the increase in commercial real estate loan delinquencies? The increase was mostly due to loans that were secured by such properties as hotels, offices, retail stores, warehouse facilities, and other types of business property. So it is not just vacant office buildings, I should say, that are having the issue, but a range of property types where borrowers are not able to make monthly mortgage payments on time or at all. Commercial real estate is becoming a more significant issue since the Federal Reserve will keep interest rates higher for longer due to the rising inflation. The longer rates are up, the less likely it is that these loans will be refinanced. The Federal Reserve recently said that if these trends continue, by the way, some banks may have to take impairment on their CRE, commercial real estate loans, and I want you to know that impairment means a loss effectively. So if we see further declines in property values, if we see vacancies that lead to reduced rental income cash flows, we will see banks having to take bigger losses. There is no alternative, unfortunately. We have both the Fed and now the Bank of Canada effectively telling us that banks are not going to have it easy. In addition to commercial real estate, banks are also seeing an increase in consumer loan delinquencies. The consumer loan delinquency rates increased, and they were mostly driven by credit card and auto loan sectors. The worst type of debt that anyone can have, of course, is credit card debt because it is a variable interest rate. So as rates go up or as they remain higher for longer, consumers are bound to struggle more and more. This is precisely why credit card delinquencies just hit the highest level in at least 5 years. Another problem that consumers are having issues with are their auto loans. The delinquency rate for auto loans now exceeds pre-pandemic level. So as you can see, there's absolutely nothing that can be used that can be utilized to address these issues within a short period of time. It will take years for this to be addressed and corrected, and monetary policy is directly responsible for this situation. If you take a look at delinquency rates in 2008, by the way, as the financial crisis began towards the second half of the year, delinquencies actually never peaked at that time. They were far from peaking then, and this was due to lagging data, among other reasons. But compare this to current readings that I just shared with you, and you will understand that we are truly inching closer and closer given the rise in business and consumer delinquencies, and banks are going to struggle with this. Now, one of the things to expect is a shift to digital currency. In Australia, all branches of a major bank effectively lost cash as they shifted to digital currency. So it might be safe to assume that Australia will not be an exception to the rule, but rather just one of the first countries to start transitioning to digital currency. As always, thank you for watching. I hope that this video was helpful and you learned something new from it. Thanks for all your support. I appreciate your kind comments and your likes. Remember to subscribe, like, and share, and I will see you back here next time. Bye for now.